The Bitcoin ETF launches were among the most successful ETF launches in history, and to say that the cryptocurrency revolution is still just getting started is an understatement. But if we are looking to invest into Bitcoin, how do we decide if we should use a Bitcoin ETF or explore the realm of BTC self-custody? Stay tuned, because in this video I'm going to break down the pros and cons of both to help us decide which is a better fit. Let's start with the Bitcoin ETFs. While these are relatively new products on the traditional finance market, they should by no means be shied away from by traditional investors, thanks to reliable offerings by the biggest asset managers in the business, including Franklin Templeton, Fidelity, and even BlackRock. In fact, I wouldn't be surprised if BlackRock had a hand in the reason why the SEC approved the Bitcoin ETFs to begin with, but that's a discussion for another time. Regardless, there are now many different Bitcoin ETFs to choose from, and BlackRock's iShares Bitcoin Trust, or IBIT, is, of course, now the largest Bitcoin ETF. But size is not everything. Currently, Grayscale takes the cake for the lowest cost Bitcoin ETF, the Grayscale Bitcoin Mini Trust, or BTC, with an expense ratio of 0.15%. This is notably lower than IBIT's 0.25% for comparison. This introduces our first negative for Bitcoin ETFs, which is the expense ratio. That is, we will have to pay the asset managers to hold Bitcoin on our behalf. Though seemingly small, expense ratios do add up over time. Every penny paid is a penny less in your pocket. This also brings up another negative, which is that by holding shares in a Bitcoin ETF, we are only indirectly holding Bitcoin, because the ETF is simply an investment vehicle that grants exposure to the underlying Bitcoin held within the ETF. As an ETF investor, we do not hold shares in that underlying Bitcoin itself. Because of this, while Bitcoin ETFs are designed to track the price of Bitcoin, there is no guarantee that the ETFs will deliver exactly the same returns as Bitcoin itself. While these negatives, the expense ratios, and lack of ability to directly hold Bitcoin, are discomforting, there are several positives or benefits to Bitcoin ETFs that may still make them worthwhile for investors. Quick reminder that this video is brought to you by you. Subscribe! The first and most evident positive about Bitcoin ETFs is that as an investment vehicle, they can be much more familiar to traditional investors, which can make us feel more comfortable to utilize them. In this way, Bitcoin ETFs legitimize Bitcoin in the sense that now we have the largest asset managers in the world supporting Bitcoin investments. But where the Bitcoin ETFs really shine is in retirement accounts. For the first time ever, Bitcoin ETFs now allow anyone with a retirement account to invest in Bitcoin. Yes, there are IRA services where you can invest in cryptocurrencies, but these often come with their own costs or fees and are not currently integrated with the roughly $40 trillion in already standing US retirement accounts. The Bitcoin ETFs have opened the floodgates to allow us to include Bitcoin in our retirement vehicles as we would any other fund. In fact, I recently utilized this strategy to nearly 10x my Roth IRA portfolio in less than 1 year. But now we need to ask ourselves, do we really want to pay someone else to custody something for us that we can easily custody ourselves? This brings me to the case for self-custody. There are obvious positives to self-custody. With self-custody, we are the sole owners and custodians of our assets, and we truly hold Bitcoin directly. We receive direct exposure to the price of Bitcoin because we hold Bitcoin itself, and we do not rely on any third parties to custody our BTC for us, removing a point of potential systemic failure and trust. This also allows us more freedom for how to utilize that Bitcoin, as we can send and receive any amount of BTC to any compatible wallet at any time. Bitcoin ETFs, of course, do not have this ability. There are, however, some negatives to self-custody. For one, it is more involved than Bitcoin ETFs because it involves personal responsibility, accountability, and wallet management. Cold storage wallets are among the most secure options but require a learning curve to utilize properly. Personal responsibility and accountability cannot be understated, because if we lose or compromise our self-custody wallet seed phrase, we can lose our BTC forever with zero chance or ability to retrieve it. With the ongoing pandemic of cryptocurrency scams, we as self-custodians must be constantly vigilant to protect our assets. Additionally, self-custody prevents us from utilizing tax-advantaged investment vehicles, as all sales of self-custody BTC will be taxed according to capital gains taxes. In other words, we cannot self-custody BTC within a tax-advantaged retirement account, at least not yet. Now, as I mentioned earlier, there are some Bitcoin IRA services such as BitcoinIRA.com that do offer investors the ability to hold BTC within a retirement account. However, even this comes with associated costs and fees, and utilizes multi-signature wallets managed by BitGo, meaning it is therefore not self-custody. So while true self-custody has its clear benefits when it comes to actually owning Bitcoin itself and the flexibility to send BTC at will, there are some disadvantages that may make self-custody less appealing to certain individuals. The good news is that at the end of the day, there are many options available to us for how to gain exposure to Bitcoin for our investments. Whether we utilize a Bitcoin ETF, Bitcoin IRA service, or self-custody via a cold storage wallet, there is something for everyone. Hopefully this video helped you decide what will work best for your circumstances. This video and channel is for educational purposes only and is not financial advice. Please do your own due diligence in order to make sound financial decisions. Subscribe, always remember that you matter for who you are, and I'll see you in the next video.